Welcome to the Money to the Masses podcast, putting you in control of your finances. One mic, two idiots, and, according to our latest figures, 3 listeners. Here are your hosts, Damien Fahy and Andy Leeks.
Hello and welcome to episode 103 of the Money to the Masses podcast with your resident expert, as always, Damien Fahy, and me, Andy Leeks. Damien, welcome back. How are we doing?
Oh, good, Andy. The sun is shining today, and a autumnal day. It's quite nice, so I'm feeling very positive.
Do you know why I'm positive about it? Is I have this mental thing in my head that I can't turn the heating on until at least October, and it got a little bit chilly the last couple of nights, and I was just hoping we'd be able to see it through to October without having to press the old thermostat button. So happy days, it's sunny. I've made it through to October without turning them on.
I think, Andy, there were lots of people in the UK who had the very same conversation as you and I were having, and my wife was texting me to say that, I think I'm going to have to put the heating on, because there was a day where it got chilly, and you get those days and you think, do I really want to turn the heating on now? Because it's a slippery slope, isn't it? Once you get on that, that's it, it's on for the duration. And also I've got that sense of trying to put off the boiler exploding because it's not been on for three months. You know, you're supposed to put it on every month just to make sure it works, and I'm pretty good at doing that. I haven't really done it this year, so
I don't like doing it. Do you know why? Because I like to save up that sort of musty, sort of dead spider, burning dust smell, because it reminds me of the first sort of few days of, or the last days of summer and the first few days of autumn. Do you know what I mean? When you turn the heating on for the first time in about 6 months and you get that weird smell in the house. Or is that just my house?
No, it's not just your house, Andy. It's everybody's house. You get that dust, that burning dust smell, don't you?
Yeah.
And and all the spiders and everything like that. Because I nothing to do with money. I managed to catch a spider. You know, I had the bee incident, the wasp incident the other week. Within the same week, days later, I ended up coming down in the morning and then seeing what was like a tarantula on the carpet, and it was a bit dark. I don't know how I didn't tread on it, and I put it in a glass and managed to catch it. I'm making it sound very, very macho and deliberate. It was a whole exercise of dancing around this thing, and I caught it, and I then decided, right, I slide a piece of paper under it to try and catch it. Cut long story short, I inadvertently killed the thing, and so I thought, oh, that's a shame. Lifted it up, and another massive one ran out. So actually, what was there were the big spiders mating. So it's true that they do come in the house and try and find a mate. They happened to find a mate on the middle of the floor. So I screamed.
So apart from dust and spiders, anything else happening in your life in the last week? Anything interesting?
Yeah, interesting. I met up with Pete Matthew, a friend of the show. Went for a bit of a pub crawl, or a couple of pints in central London, because people who listen to this podcast, a lot of you also listen to Pete's podcast, Meaningful Money, and Pete and I met up in London for, it was quite impromptu actually. He happened to be up in London. He's down in Cornwall way, isn't he? And he came up for, I can't know why he came up. It wasn't just to meet me. It was for something else. We had a couple of beers and a curry, which was brilliant. And we said at the time that what we should do is the 3 of us should go out in London and invite all our listeners, like a big open invite. You and I have threatened to do this for a while, Andy, and I thought it would be quite good fun. We took a picture of ourselves and put it on our Facebook. You can see me and Pete grinning like idiots at the camera. And it was funny though, because you're sitting in a bar and we do like podcasting, and we were amongst quite a few people who were city-like. We weren't in the city, but it was almost one of those things, if somebody had asked us what we did or what was our common theme, that how did we know each other, it would have been a bizarre conversation about podcasting and things like that, because most people probably don't even know what a podcast is, to be fair. Yeah. So I did that. I then did a presentation to a bunch of IFAs, financial advisors, about how to engage with their clients, to get out there and do what we do, Andy, to reach the masses. And financial advisors are very inward looking, and so I was there, did a presentation to a whole bunch of those, and had some slides. I think if you look on Facebook again, there might be some pictures of that, of me standing up there doing that. And one quick thing before we get on the money stuff, I don't know if you saw, Andy, but people who listen to this podcast will remember or recall, for the last possibly 2 years, I've laughed at Andy at the fact that he claimed there were these things that you could put on bike wheels.
And they featured in our 100th episode as well. And I still maintain one day I saw them once.
Yeah, the idea was that you could drive along on your bike and you had this LED in your wheels and it made a picture as you sort of sped along. And I laughed at Andy. No one seemed to know about what he was talking about. Andy was adamant he'd seen it. And actually Andy's had the last laugh because another Andy Norman, contacted us via Facebook and put a link to a video that shows these things in action, which is they are amazing, Andy. They really are good. Go and have a look on our Facebook wall. You'll see a link from the Andy Norman posted, and you'll see these things in action. And I will eat humble pie quite happily because I actually would, if I had a bike, I would want some.
Imagine how that looks on that video. Now, imagine putting yourself in a situation where you saw one in real life, and then everyone you told didn't believe you. That's my situation.
Oh yeah, I think you bike, Andy. You should get some. They're called Monkey Lights.
Okay,
that's the name of the brand, Monkey Lights.
I'll have to have a look. I don't like. The problem with that is the fundamental problem with that is I'm quite scared of riding at night time because I live out in the sticks and there's no street lights anywhere, and so riding at night is like literally riding in the pitch black. Maybe having some lights on your spokes is going to help that. So maybe I should do it.
Well, they claim that. They claim that it could help safety. I just think the idea of having Pac-Man and all these things that they've got in the video is not really a safety. It's not a safety proposition, is it? It's just something that's a piece of fun. So I want some Monkey Lights, but I need a bike. Right, on to the money stuff, Andy. What are we talking about this week?
I was going to ask you just that. What are we talking about?
I thought we'd do a couple of pieces that are around almost contingency stuff. Last week we did a big piece on my tip. Do you remember? It was financial well-being, the secret to financial well-being. It was a really popular podcast. We've had some of our best ever days and downloads this week, and I kind of wanted to take that further because really what that did was sum up a lot of what I think about money into one piece, the one thing you had to do.
Okay.
Now, I'm taking that slightly further, and I'm going to give 3 things. The 3 bare minimums you should be doing with money, with your finances, to sort of just at least tick the box so you know that you're doing okay. So a bit like you get in the car and you put your seatbelt on and you check you're not in gear and all that sort of stuff. The bare minimum. This isn't going to transform your life, but it will make a difference. And it's just the things that the first things you've got to do. And another piece we're going to talk about savings, and then finally I want to talk about peer-to-peer lending. Peer-to-peer lending is becoming huge, and especially as savings rates have plummeted. And I want to talk about what to look for, a bit of a checklist on peer-to-peer lenders, because we're starting to do comparison stuff. We're looking into doing that on Money to the Masses to allow people to find these things easier, to search for them and find good rates. And previously I wasn't a fan of peer-to-peer, and I'm quite happy to change my mind on something. And I did a podcast previously explaining why I did now think it was a credible thing to do. So one of the things I'm going to do is do a piece on that, a checklist, if you really want to kind of get under the bonnet of these things, what you could look at.
Good. Well, should we crack on? What have we got first?
Well, let's start with the piece on savings. Now, this was a story that appeared in the press saying most people have less than £100 in savings. It was Millions, I think the title was. Millions have less than £100 in savings. Now, that doesn't surprise me. It's almost more surprising was that the headline on the BBC had the kind of shock value in it, because I don't believe most people do have savings, and of course it's one of the things you should try and do as a bit of a buffer. And I want to take a evergreen spin on that. We always like to make content so it lasts forever. We don't want to just focus on one thing. So it was really about that idea. Most people were going to be listening to this and think, yeah, I don't. I'm living more hand to mouth. Most of us do. And what can you do if you want to start saving? And something to make you feel a bit better if you're not. So the first idea, Andy, is that we've touched upon this sort of sprinkled through occasionally, but the idea that there are tools out there now that can help you save money as you go along. It's all about just doing bit by bit. It's a bit like the podcast I mentioned last week, where you get the power of time involved in what you're doing, and you just try and do something. So you just live your life, and then by default something will happen because you can't stop time. And I know that the bank that I use do Save the Change. We mentioned it before, Andy. You now I think, do it. And there are other banks out there and apps that will allow you to spend money in a shop, and then they'll round up that money and then put it in a savings account. So you spend 150, 160 on whatever packet of sweets, food, chocolate, whatever, and then they'll do the extra 40p will go into a savings account. Now that was really pioneering about 5-6 years ago. No one did it. Very few still do it now, but ask your bank if they do, because a lot of them do, but it's hidden, and they'll put the money in a savings account every time you use your card. So what you're doing is kind of harnessing that time idea. You're living your life, and then by default, money will start to accrue. And a very good way, you do it now, Andy, don't you?
I do. As someone who's done it fairly recently, you're absolutely right. It was really hidden. It's not sort of made obvious. It took me a good few days to get my head around it and select various different options and try and work out how to do it. But I did it. It is worth investing the time, because in the I think it's 4 months I've been doing it now, I've got over £160 in there. So it's well worth doing. And I haven't missed that money.
And that's the point. You don't miss the money. So it's kind of introducing the idea of saving without even trying. Now there are apps, like there's one called Spending Tracker that can actually track what you spend yourself and split it down and what you're spending money on. So you could try and cut down using that in terms of the excess you're spending. But it also allows you to therefore try and build a fund in a way. If you can cut down your spending in some way, see what you're spending, you might be able to put money away. But I like the idea where it happens by default. There's not a point where you have to sit down and do that calculation. So that a thing like Save the Change, it's a shame, because there used to be an app that did this as well that went bust, and I think there just wasn't enough people using it. And what they did is they didn't transfer the money themselves, but they actually made it simple for you to do. They worked out your spending and all that sort of stuff, and then you could press a button, it could transfer money. Now the new thing that's quite good is there's an alternative to just saving. There is an app called Moneybox that allows you to put money into a saving, into an investment, so into an ISA, and instead of putting into a savings account, then you're making the money grow. I mean, savings rates are pretty poor, and the savings rates you get from those Save the Change kind of ideas on bank accounts are pretty naff as well. But it's really about building a fund, isn't it? It's about just trying to grow something you can use, not about getting a massive cash pile. It's kind of good saving for Christmas kind of stuff. But Moneybox, this new idea, money, I think a bit sneaky actually, Moneybox, and taking that idea, because obviously that's the name of the show run by Paul Lewis, and it's nothing to do with him. This is just a startup who are using that term, and they will invest the money instead. So I quite like that idea. It gets you into building, into investing. There's default funds, and then you could obviously move it later at a later date. Now, one thing I want to inspire people with, or just let people think about, is that if you haven't got the means to build a contingency fund, or you haven't got the discipline or anything like that, there are alternatives, because they always say you should have 3 to 6 months savings, and I just think that is, I mean, yeah, we'd all love to do that, but that's just not reality, is it? If you're fortunate enough to get to that point, well done. That is where you go. That's one of those minimums, okay, you want to try and get to. And I just want to point out to people that there are insurances that you can take out there that might be able to help you out. Because let's be honest, the contingency element of saving is to stop something like if you lose your job,
yeah,
and you can't pay your rent, or if your boiler blows up and things like that. So one of the things is to look at to the insurance element that you can explore. Now there are things like income protection is one of them, as you know, Andy, being an insurance guru that you are, as well as an accounting genius. There's something called income protection that basically will pay out an equivalent sum of about 70% of what you earn. And if you become, it could be one of a number of things, but you can become unable to work in terms of being sick, have an accident, or redundant. And it's something to look into. If you go onto Money to the Masses and you go into the search and put income protection, it's a policy that will pay out if the worst happens in terms of your, like say, you can't work. And those policies are actually relatively cheap, because the way they work is they pay out if you can't, like I say, let's just say you had an accident. They normally have a deferred period before they start paying out that sum of money that is, say, equivalent to 2/3, 70% of your salary. But that will cover your bills, hopefully. So that's good. But they're not that as expensive as people think. You can get like a standard one that and when I say standard, they actually vary based on things like your age and your medical history, because obviously if you're a very sick individual, the insurance companies aren't going to make it too cheap for you, are they? So let's just take a very simple example. If you're like around 30, you're probably going to be paying something like £30 a month for £1,500 a month sort of income, and with a deferred period of 4 weeks. And that jumps up. So if you then go up to, say, age 40, you're going to be looking at £35 a month. Maybe if you're age 50, it'll be £50 a month. Those figures are very loose, and they give you a broad sort of figure. I mean, that's quite... If you imagine the sum of money you'd have to save to get a contingency fund that will pay out for, say, £1,500 a month or whatever. And don't forget, these policies will pay out until you can go back to work. So that could be years. And that makes them very cost effective, although they are on the more expensive end of, I suppose, of insurances, but they are cost effective. So there are other things out there, people to look at, and you don't have to try and save up thousands and thousands of pounds.
Yeah, absolutely. I mean, income protection is one of those policies that you really should consider. It's not one of these fly-by-night type things that won't pay out. I mean, the payout percentages are really high, sort of 90% of the claims pay out. And again, you've got to remember that this could pay out till your retirement. So if you're taking out a policy in your 30s, you know, if the worst should happen and you can't work again for the rest of your life, this policy will pay out for 30 years. If you think about how much that's paying out hundreds of thousands of pounds worth of income replacement. That's actually crucial for you to really carry on functioning as you would like, and not having to sell up your house and do things like that. So, yeah, I love income protection as a policy. I've got the policy myself because I see it as, peace of mind and crucial really for my family. If the worst should happen, it's nice to know that there's a buffer there and the bills can be covered.
I mean, on that note, I mean, those prices are relatively low. If you think you're trying to build a buffer, you're going to be putting more than that away anyway, aren't you? A month, if it's going to be a serious buffer to be able to cope with those things. One last thing on that. If you want to see the impact of this stuff, there was a campaign that was run by a few of the insurance companies as a kind of it really was trying to educate the public about this stuff, because most people have never heard of these types of policies, and it was called 7 Families. And if you Google that, it still exists online. And what they did, they found 7 families. Correct me if I'm wrong here, Andy, but the premise was they found 7 families who had devastating things happen in their lives, like say a young guy who had a stroke or stuff like that, couldn't work, and the impact on their families were huge. And they basically gave them the equivalent of what would have happened if they'd had income protection policies, wasn't it? And
yeah,
it's quite an emotional thing to watch these videos. These are real people, and it didn't get quite the exposure that I think it deserved. It got some in the press, but again, it go and have a look at it, and you will relate to at least one of these scenarios.
Yeah, absolutely. 7 Families, check it out. It's quite inspiring and emotional at the same time, because it really helped these 7 families in question, but it just begs the question how many other families that didn't have this help and support financially, how they suffer as a result of not having the policy. So yeah, do consider it. It's good. Okay.
So that's a great message to take from today anyway. Just even you look at it, even if you don't do anything, just you've got to be aware. Now, I said I was going to talk about 3 things that I'm always asked, that what should I be doing? And the cash lump sum idea, you know, the having money in savings, is one of those things if you can do it. That's kind of one of the 3 things I would say. But obviously my slightly different take on it than most people who just give the old stick, save money into a savings account, is that last piece that we just did. So leading on to that, there were 2 more I want to just shout out for people to do. This isn't just to consider, this is go and do. Life insurance. Make sure you've got some life insurance that by a bare minimum covers your mortgage. Because the idea that if you die your mortgage isn't paid off, the mortgage company doesn't really care. These guys have there's a huge debt that you owe them, and they want it paid. And now, of course, they can be understanding, but at the end of the day, if you die and you're the main breadwinner and your family can't afford to pay the mortgage, the upshot is they're not going to let them live in the house for free, and they'll end up losing their home. So as a bare minimum, I know you don't end up... Some people think it's quite clever. There's been things where mortgage companies say you have to have life insurance to get a mortgage and all this sort of stuff. And of course, it's not true. And so they think it's quite clever not to have done it, and they saved money. But at the end of the day, the reason it's worth taking out life insurance to cover your mortgage is because of that scenario whereby if you die, your wife and kids or your husband and children can actually keep a roof over their heads. And it is cheap, because if you've got a repayment mortgage, the lump sum, the level of insurance you get, you can get policies that are called like mortgage life insurance policies or decreasing term insurance, where the level of life insurance decreases as time goes on, so you're paying less and less, and you can get policies like that for between like 15-20 quid, and not even that, which is really cheap. So that's the bare minimum. Make sure if you die that the mortgage is paid off, because at least then, even if you don't have any other kinds of insurance or savings, then your partner isn't going to be booted out on the street, and then the only thing they're going to have to do is probably find a little bit of income to pay the bills. So get a bit of extra life insurance that will cover those bills for a little bit longer. The other thing is, do your will. Make sure you have one. If you've got children, make sure you, after this podcast, go and make a will. You can, there's some services online. 10minutewill.com is one I've used, and it will do a will in a very short space of time, 10 minutes, that's hence the name, and it's relatively cheap, 60 to 80 quid I think it is. If your will is very simple, your estate, say you want to leave everything to your wife and vice versa, and then to your children, but it's important because your will also not just divvy up your assets, but who's going to look after your kids if you both die in a car accident or something like that. So those are my 3 things I would say. If you do those, have a will, have enough life insurance, and then have a buffer if you can. If you can't save and you can't take insurance out because you haven't got enough money, then at least have access to a credit line, say a credit card that's got a little bit of space on it that can tide you over for a bit. You don't want to live off credit, but if you haven't got means or access to any, then because you've maxed out or anything like that, then try and get it down and try have access to a credit card that gives you just something that if the boiler blows up, you can actually pay for it and stuff like that. So they are my 3 things. Other people may have others that they think, and do write in, tell me yours or whatever, but they are the ones that I would say. If you do that, then everything else from there, that's the great foundation and building blocks.
Great advice. I sadly have only got 2 of the things that you suggest. I'm still to do a will. I think the reason I've been putting off a will is because we're currently in a situation where we've got no mortgage. So in my head, there's nothing really to divvy up. It's just our possessions. But that's so wrong, because you made a really crucial point there about, God forbid, if something were to happen to both of us, who would look after our children? And that is where the will comes in, as well as doing lots of other clever stuff as well. So I should get on that. And actually, Damien, you mentioned about the fact that having a buffer, even if you can't afford to get insurance, or if you can't afford to have that buffer, freeing up some credit somewhere just as a sort of peace of mind, you'll be possibly you won't be surprised, because you're in the industry, so you probably wouldn't be surprised. But I work in payroll of a mid to large size firm, and the amount of times I hear from people that are, financial hardships. Can I have an advance on my salary? Is there anything you can do with an emergency loan or things like that? And obviously there are lots of people out there that aren't in a position where they've got any sort of a buffer, and they feel like they can't lean on friends and family for whatever reason. So I'm seeing it in real time that, this is obviously an issue. So people do try and do it, definitely.
Yeah, I mean, that's a brilliant example what you're saying there, Andy, because being in such a firm like that, you see so many people's lives, don't you? And you see that it's hundreds of people's lives that you're kind of hearing those stories, and unless you see somebody next door or friends where you see this stuff go on, and lots of people are very secretive about their money, which is totally understandable. We're very British about it, and that was going back to that 7 families idea. That was the point of that, really, wasn't it? It was trying to bring out the real life stories. People relate to stories, and as soon as you see something happen to somebody else, you think, blimey, I should sort that out.
Yeah.
And it's only then at that point. But of course, what happens, we're human. Don't beat ourselves up about it. We are human. We don't do things. No one's perfect. But it's kind of, if you tick off those couple of things, then you know that you're going to be all right. You're not going to be a disaster. You won't avert disaster. If something really bad happens, then you're still going to have problems, but it might make it a little bit more of it's a bit like if you're boxing, you get a bit of a haymaker. You might stagger on your feet a bit rather than go down on the canvas for a full count of 10. So there are my tips. Right, on to the next thing, Andy.
Yeah, what we got coming up next? You mentioned it earlier.
Yeah, peer-to-peer. Peer-to-peer lenders are, for those who don't know, are they cut out the middleman. In the world of finance, what traditionally would happen is you'd save your money in a bank account, and then the bank would take that money and chop it up, parcel it up, and they might lend it to somebody else, or they might invest it, okay? And they would take a return on that. So they would give you a poor savings rate or a lower savings rate. They might lend it to somebody else in the form of a loan, not your money directly, but the whole pool of money that the bank has, and they'll make a higher rate on that because it's a loan. Now, peer-to-peer lending cut out that middleman, and they, with the power of the internet, managed to can tie up savers with people who want to borrow money, and that can be individual people, or it could even be companies who are looking for funding or loans. So it's a huge market that's exploding. There are some big names out there that are going to be launching products. I won't say them because I might have been privy to conversations with some of the big firms, and they can change their plans and stuff like that. So I don't want to say something in case I get somebody into trouble. But it is one of those things that is going mainstream. It really is, and there are some well-known companies that are starting that are out there. And one of the things people don't realise is that peer-to-peer lending is in. They're probably using it and they don't know. There's companies like giffgaff who do mobile phones and SIMs and stuff like that. Now, they use peer-to-peer lending to give you the kind of loan in the background so you can actually have a phone and everything on credit.
Right.
So you might be using a peer-to-peer lender. Rate Setter is the peer-to-peer lender in that case. If you look on your small print, you'll find it on there, and you might not even realise that that's how integrated it already is in our economy. So there are people understandably using peer-to-peer lenders now for their own benefit. So they want to save money and they want to get 5% rather than a measly 1% from saving. So they will give it to a peer-to-peer lender, 5%, and then their lender will lend out to other people. You can have elements of control, and there's different lenders. So what I wanted to do is very quickly run through a checklist that people could use if they want to dig a bit deeper beyond the rates that they see on these comparison tables. We're going to start doing a bit of comparison on Money to the Masses, so go on our site and search, you will find it. But if you want to dig a bit deeper into the T's and C's, then this is for you. So one of the things I would say first and foremost is that if you're going to look at a provider, then just consider how long they've been around. I mean, are they a new entrant? Are they one of the established people? Have they been around for long periods of time when there's been markets ups and downs, particularly in credit markets? So going back to financial crisis, there's not many that really have been, but we've had wobbles along the way. Is there a contingency fund? It's sometimes called a provision fund, whereby it absorbs the losses. Because obviously, if you think about it, you lend your money, and just to give an example, they might chop it up into 100 pieces and lend it to 100 people. And some of those people might default. Like, that's what happens. Now, the peer-to-peer lender has to do their own underwriting. That means they're going to assess the risk of individual people, reject those people they think are a bit of a risk, and then lend to the ones they think are good. And so you're trusting that. That happens in banks, but with peer-to-peer lenders, you're trusting their own individual algorithms or risk assessments. So they also may have, to help as a buffer, they build a fund, a provision fund, to account for when something goes wrong. They'll absorb some of those losses rather than you. And I've been in, and I don't mind mentioning the company, because I was invited in by Rate Setter quite a long time ago to go and kind of kick the tyres. I don't like that phrase, but it's a good analogy, really, of how their provision fund works and how much money they've got tied up in there, just sitting there to absorb those losses if they have a sort of mass default event. Say there's the credit lines crash globally, a bit like another financial crisis. It's quite impressive, to be honest. And they were very open. So check that out on any peer-to-peer lender. See if there's any sort of securing of the loan. So the people who are borrowing the money, is the money they borrow secured against anything? Or is it just a case that the lender just hopes they pay the money back? That might be an interesting point. Who are you lending to? Is it individuals? Is it businesses? Does the lender even know who they are? What sort of sectors are they in? Are they in sectors that are, I don't know, some novel, like new ones, tech? Are they startups that they're lending to? And the other thing is, what is the typical loan term of these things? Are you locked in? Is it 1 year, 3 year, 5 years? Most of them are for sort of 3 to 5. And can you get your money back? Is there an early release clause? Is there any penalties for you releasing early? And how diversified is the loan? So when you give your money, do you have control over who you lend to? Some give you an element of control. Others will just diversify it. Do they diversify across individuals and businesses? Is it a whole range of people? Find out what their loss rate is, the amount of defaults they've had. They will tell you. They should tell you. It will be there somewhere. Dig a bit deeper, make yourself comfortable with that, and see what it's like compared to some of the other names that are out there. There will be defaults. Banks have defaults, and it's about the if it's relatively low, and it's going to be very low, to be honest with you. And then and they have a good provision fund that hasn't been called upon, because some of them actually, these provision funds, they have outside auditors who come in and audit them. It's not just them saying, oh, we should have 15 million tied up in a bank just in case. They have outside auditors come in. So check if it says who's audited it. And check, obviously, the most obvious thing, which probably I should have started with, is check the rates and compare them against everybody else's that are out there. And whether the risk you're taking is actually worth the reward. Compare it to traditional savings accounts. And on our site, we do have a comparison tab for all those things. So that is a quick run through that I give people, because what happens, you get a lot of paperwork, or you look at their websites and T's and C's, and you sometimes think, well, I don't really know what I'm looking at, because the peer-to-peer world is very different to the traditional bank account world.
Yeah.
And so go and have a look at these elements, because they will make you probably a bit more happy or satisfied, or you may reject somebody altogether.
So is it right, would I be right in saying that a few years ago, peer-to-peer was seen as something that was very new and a fairly risky sort of bet, if you like, because of the regulation side of things, and because, am I right in saying that they're not, or they weren't, in the financial services compensation scheme, so it's not kind of backed up? That's why they have the provision funds. Yeah,
you're right, Andy. I mean, that's a good point to pull out. That's why there's been. It was always the reason why I didn't like them, and I wouldn't recommend people wade into these things, because obviously the financial services compensation scheme covers banks, and you can look up on the FCA website to see who's covered. But peer-to-peer is not covered by it now. They are now regulated. They weren't regulated before, but they are now. I think whether they will be covered by the financial services compensation scheme, when that's basically the scheme where if your bank goes bust, you get your money back, up to it's £70,000 for a single account and £140,000 for a joint account. Now, what am I talking about? It's £75,000 per account, and therefore £150,000 for a joint account. Those, they aren't covered, but the provision funds on some of them are very good, and if they've been audited, and it may give you a sense of security and just peace of mind. So I would never put my life savings in a peer-to-peer. There are people who do, and it's been fine, especially with some of the big ones who have these independently audited provision funds, but they might be a way of diversifying. And like you diversify when you invest, or you diversify your savings, you might have most of your savings in traditional accounts and some in peer-to-peer. So I suppose the message is, I would consider peer-to-peer, but I wouldn't bet my house on it, because of the lack of protection. But if you check these things, you make yourself comfortable, you know what you're getting into, then you should be okay.
Brilliant stuff. Enjoyed it as always. I take it we're done for this week, Damien?
Yes, we're done and dusted, Andy. As ever, people can get in touch via the website or email at podcast@moneytothemasses.com, or via Twitter at moneytothemasses with the number 2. Oh, of course, the final bit is, please do leave a review. We need reviews. They help push us up the charts. So if you enjoy this podcast, go on there and give us a 5-star review and just say how wonderful the podcast is. And that's it, Andy. Until next time.
Good stuff. See you next week.
Bye.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.